Today we have a special guest with us, Mr. Kevin Shortell, who is one of the experts at investing in notes in the United States. So he has generously decided to come on the webinar today and talk a little bit about what he's got going on. So Kevin, how's it going?
It's going great, going great. Thanks for having me on. And I always appreciate talking to your group. And as you're right, I am working with several people now from Money Club, and they're doing great.
Awesome, man. Well, I'm glad you're here. And I know notes always comes up. You know, people kind of, it's one of those things, I feel like it's one of those investments that people kind of forget about sometimes or don't even realize that it's an option, but it's such a solid return. And it's, you know, compared to everything else, like the stock market right now, like the risk level and stuff, you know, so.
Yeah, it really is. And it did start as a niche industry. And it's a good question. I had a conversation actually with Mr. Kelly. He's one of your people I met through the Money Club, and he responded to one of the notes that I posted on Slack and ended up buying that. And now we talk every week. He's gotten into his second note already, and had a conversation with him yesterday that many people might relate to. Is that the note business, even though it is a niche, it's really a multi-trillion-dollar business, and it goes above and beyond real estate. By the way, I was talking with him yesterday about buying royalties from records and books and professional athlete contracts and casino winnings. I mean, all of these things, what they have in common is they provide a monthly cash flow, sometimes annually, sometimes quarterly, or let's say monthly cash flow, but they're secured by something, you know, and that's really what this business comes down to, is how much am I investing, what's my return, and what's my risk, which is going to include what's the collateral backing this. And that's really all the debt buying is about. I focus on the real estate now, although we've bought in the past lottery winnings, casino winnings, and athlete contracts, all kinds of crazy stuff. I focus on the real estate because it's so much more tangible, right? And we know what real estate is worth. We know it's there, and we know if we're not being paid, we have actionable steps that we can take to make sure that you know, we recoup our investment plus profit.
Yeah, no, that makes a lot of sense. I never realized that you could get into all those different avenues as well.
Oh yeah, it gets pretty crazy. In fact, you may have noticed, I mean, I hate to go way back, but David Bowie was really the first one in the music industry that sold his whole portfolio of music royalties and sold them on 10-year bonds. And they were called Bowie bonds. And that's why he disappeared for quite some time. And he sold all of the royalties for cash now, which is the same thing people sell notes for, or lottery winnings, that sort of thing. And then he also promised to produce 2 more albums. Well, of course, the risk for the investor is, well, what if you don't? Or what if you pass away? You know, something happens. And he created 2 new albums before he ended up passing away. But there was a huge insurance policy on him to cover the risk. You know, and the same thing in real estate, we have the property, but we also make sure that our property, which is our collateral, is also insured, you know, so it's really the same play. But there's artists now, I think Bob Dylan sold his portfolio. I think Stevie Nicks was looking at selling hers. So it's quite a popular thing now that's coming back around for them to do that.
Wow. So that's something that just anybody could get into, huh? Like purchasing stuff like that?
On the music side, or on the business accounts receivables, or?
Yeah, just in general.
Yeah, there's actually gosh, I'll have to look up the website again. There's a website that you could go on and buy music right now. It might be a combination of a number of songs. It might be one song. It might be an album. Just all kinds of stuff like that. And that's where it is funny, because every time I bring up these other cash flows, that's where people start to go, oh, okay, now I can kind of see what's happening. We looked at a business note, another client of mine happened to be right here in Central Florida where I live. And the guy sold a business, and he took a lump sum, but then he took the rest in an IOU, right? So the person who bought the business gave him 200 grand, and then they created a $50,000 note, and the guy's going to collect the money on the note. So that's a business oriented note. And you have to look at, again, well, what's the collateral? In this case, the collateral was really just small equipment, which doesn't add up to anything, right? Computer, desktops, you know, that kind of stuff, that's worth nothing. But what else was there? And with business notes, a lot of times it's just goodwill. We have a good customer base. Not the best collateral in the world. So you have to look at that collateral and go, well, is there a trademark? This business happened to be a dispensary for marijuana, which is legal here in Florida for medicinal purposes. So, you kind of look at that and go, but they could go somewhere else. Do you have a trademark, or is there a license that is valuable? And I don't know if there is or not in Florida, for someone in that business. So that's what we're always looking at. What's the cash flow? What's the return? What's the risk? And we have to look at that, collateral, whatever it may be, but it can be a wide variety of things. Sure.
Wow. I didn't expect this conversation to get started this way. That's
I know, right?
that's really cool stuff though, man. It's something I never even thought about. So yeah. I think we're gonna get into some good stuff today. So for anybody that doesn't know you, Kevin, we got a good little group on here right now. So anybody that doesn't know you yet or hasn't met you on one of our, so Kevin comes on all of our 3-day essentials trainings that we do, that Chris and I do. And he's been working in the private money club, posting notes in there. But can you just give him a quick background on you, Kevin, and kind of what you do and what you've done? And
yeah, sure. Absolutely. I started really in the more traditional real estate business. And I met a guy who introduced me probably 35 years ago into the note business. And he showed me a check he had just made on this note deal, which was brand new to me too. I mean, I didn't know what notes were, didn't even think about it. It was always sticks and bricks, buy the property, rent it, buy the property, fix it up. And he showed me what he was doing. And I was like, man, that's really awesome, because you can be at home. And back then you really we didn't have the internet, so there wasn't that. It was basic, really, really basic things. You'd go to the courthouse, do your research. And I ended up, because a marketing background and educational type of training background, I worked with him as a partner, and we built that business up. And really back then, all we were doing, which you could still do today, by the way, is essentially wholesaling notes. We would find deals. We didn't have, we did a $10 million lottery winning it, for just to stay on that vein a little bit, for somebody. So back then, you didn't have a lump sum option. You were paid over 30 years. So we didn't have $7-8 million to pay the guy, but we knew companies that would. So we basically just found deals and then brought them to the buyers, and we made fees in between. And that's still done today in real estate notes every single day. In fact, top producers in that can make 6 figures just finding deals, putting them together with money. And by the way, there are companies that have the money every single day. Their whole business model depends upon people bringing them opportunities, and they're backed by banks. So they essentially have unlimited funds. So that's how we started in the wholesaling business. And then there's natural to, you start to buy your own notes. You start to then create your own notes and sell notes in full and part, and really get into more of the trading side of the business. But I was also interested in the educational side, because my thought process initially on training people was, well, I'll train an army of people to go out there and find notes. They'll funnel them through me. I'll get them purchased either with our capital or other people's capital. And that's really where it started from on the educational side. And it's something that I really clicked with and went on and enjoyed teaching and training people. And I've done that for quite some time now, over 20 years.
Right. Wow. All right, cool. So do you have anything new that you're teaching or educating, or any new programs, or what do you got going on right now?
Sure. And I'm prepared for whatever you want to do today. If you want to just give a Q&A, or if you want me to show some slides. And
yeah, I think that'd be great. Yeah, I mean,
yeah.
in the questions, where would we find a template example of a note if a template is available with you folks? So that might be a great way just to show her the blacked out one and kind of what you see when you have a note.
Yeah, sure. Absolutely. We can do that. And by the way, to the short answer to your question is notes, and really all of the real estate contracts we're dealing with, those you can get pretty much anywhere. You can go online to like deeds.com, legal, zoom.com. These are pretty standardized contracts that you have today. There's some exceptions in there, some advanced contracts we use on parcels and things like that. But a standard note, believe it or not, is a very, very simple instrument, as is a mortgage. But of all of them, a note is just an IOU, and I can certainly show you how that works. So can I share the screen? All right, so you guys can see my screen now, I believe.
Yes.
All right, so I'll jump right to the deal instead of the stats then. All right, so I posted this one last month, made it available. It's a note that I had found, and anytime you're looking at notes, the best way to look at it is there's 2 things. When we buy a note, just like any investment, we want to know the story and the numbers, behind it. And that's what I like about the note business is putting that all together, because that will minimize your risk, maximize your returns when you master both of those sides. If you just look at notes as numbers, at some point in time, you're going to get burned because the story wasn't right. In other words, what's the borrower's pattern of making payments? What have they done in the past? What's the likelihood that they're going to stay? Are they taking care of the properties if they want to stay in there? So behind all these numbers, we have to understand there's still people there. So if you just understand the people portion, the story, but you don't look at the numbers, you're going to get burned as well. So ideally, you understand both. And it's a property in Walton, Indiana, which probably nobody listening can pick out on a map, but that's one of the other nice things about the note business is it doesn't matter where the collateral is. We go to where the opportunities are. The value of the collateral matters. The potential value of the collateral matters. The borrower matters. Our return matters. But whether it's located right next door to you or across the country, that part really doesn't matter. And that's one thing that real estate investors typically have to get over a little bit. They're used to the touchy-feely sort of thing, but you lose that pretty quick. So this property is worth $64,000. Now, we don't live in Walton. We're not going to fly to Walton, anything like that. But are there real estate agents in Walton that can do a BPO for us, a broker's price opinion, come up with a value of what that property's worth? Of course. And that might cost you $150. Now, we have vendors that have relationships with agents throughout the United States that do that. So we're not just getting into the phone book, if you will, and picking out somebody at random. It's somebody who is subscribed to a network that does that very specifically for us. So our collateral, what's backing our investment, is $64,000. And get this, the owners of the property have been living in that house and making payments for 10 years. That is a long time. They have built up equity. They want to stay there. Evidence on the pictures looks like they have kids. The kids probably go to school there. Their work is probably there. And they're pretty well entrenched in this area. So again, your mind starts to go to what's the likelihood that they're going to want to continue to stay and pay? How much are they paying versus what rent would be in the area? And you'll see in areas like this, their payments, I forget, we'll see it in just a minute here. Their payments are probably $500-600 a month. Rent is probably 3 times that, in the area. So there's incentives and motivators like this on why people would stay. Now, what we're looking at from the investment standpoint, for those of you who are new, I'm not looking to buy this house. They own this house. They're on the deed, but they owe money on the house. And when they owe money on the house, they promise to pay it back. And that's what a promissory note is. And they said, if I don't pay you back, you have the right to foreclose on the property. And that's the security agreement. So when we buy notes, we actually buy secured notes. Notes are secured by a mortgage. Okay. So if they don't pay, then we have rights that we can go after the property. That sort of thing. So that's what we buy. We're buying the debt instrument on that property, not the property itself, which also means I'm not a landlord. I don't have to worry about this eviction thing and all that other stuff that landlords are struggling with right now. I don't take care of the property. They do. They pay the taxes. They pay the insurance. I'm just the bank. I'm just collecting the payments. And that's exactly what we do in the note business here. So the story behind this story is, how did we get to where we are? I'm going to show you these documents, time willing, I'm sure. This property was purchased from Fannie Mae by a big company. And this is pretty common. Fannie Mae will sell bulk property instead of foreclosing to big companies. We're talking companies that have hundreds of millions of dollars. They buy maybe 5, 6, 7, 10,000 homes from Fannie Mae. They renovate them and then sell them. Now they have third-party companies that do that for them, but they sell these properties with seller financing, especially in the lower price band. Now, I know, Stephen, you have people from all over the U.S. and other places in the world, and they might be looking at a $64,000 house going, it's got to be a dump. This has to be. No, in Walton, Indiana, this is a middle-class, working-class, 3-bedroom, 2-bath home. Right. And that's a solid investment in that area. So if you're in California or New York or other places where you're just going, these houses have to, no, these are nice, solid deals.
Yeah, we have a borrower that works out of Indiana, and he just had a deal recently that was like 60, 70 grand, but it was a great deal. I mean, so
yeah, absolutely. So Fannie Mae at some point in time, who owned the note, they foreclosed, which by the way, cleans the deed. which is nice. And then they went ahead and sold it to this other company. This other company sold it with seller financing back in 2011 to the same borrowers who are in there today. Now we call that seasoning. Payment history in the note business is called seasoning. So this would be considered an extremely well seasoned note. They've made their payments for 10 years. They've built equity within the property. They've built a life within that home. And the likelihood is that they're going to continue to pay, or maybe guess what? They sell the house and upgrade to something else and you would get paid off. So either way, you're good. So in the same posting, I said that I have all the loan applications, the security agreements, the transfers, the escrow agreements, and payment histories. And those are the things that we need in the note business. We're not buying the property. We're buying the note. So how do we research the property? The good news is we don't have to drive around looking at houses. We don't have to do all that. We have all of these documents right online, right? And you just look them up. You have to know what to look for. You have to be able to put them together to see it started here, then it went here, then it went there, and now this person's selling it to me. Or do we have a break in that chain? Right. So these are the things that we look at. Now, the investment on this one was $39,500. You would receive $373 a month for 250 months. So Mr. Kelly, who contacted me on this one, he got this thing funded. He's already received his first payment. He's looking at his second note. He probably has already put the offer in. We have an appointment every week now, and he's going to receive payments for 250 months. So the return he's getting every year is 10%. But again, he's not a landlord. He's not having to upkeep the property. He's not taking on the risk of the landlord or the responsibility of the landlord. He's just getting that cash flow secured by that property. So let's take a peek behind the scene here and show you what this would look like. So when I went over this with Mr. Kelly, again, we want to establish, where did this come from, right? Because we do have concerns with deeds, right? If you've ever bought a home before, anybody listening, watching, if you bought a home before, one of the things you did when you bought that property was get a title report, right? You wanted to make sure that this property, the person who owned it actually owned it, and they're guaranteeing that the title is good and there's insurance on it, that sort of thing. That's what we're looking for. Where did this start? So this is the actual document. You can see when it was all recorded back in 2011 here. And this is when Fannie Mae, Federal National Mortgage Association, bought this. Actually, they backed the loan from a bank. So this might have been Wells Fargo who did the loan. Wells Fargo sold the loan to Fannie Mae. So Harbor Portfolio, which is your big multi-million-dollar company, you can see they have a number of funds here. Harbor bought this property directly from Fannie Mae. There's no note at this point in time. They're just buying the deed. The deed is the document of ownership. So Fannie Mae deeded this property over to Harbor, and you can see Harbor paid less than 10 grand for that property. Okay. Now they had to renovate it. It was also part of a package of 5,000 homes. So if you're thinking, oh, well, I can just buy property direct from Fannie Mae. Yeah, you can if you have a couple $100 million. Okay. So they bought this as a part of a package, and then they did what? They had to fix the property up and resell it. So that's it. There's the deed. I mean, it's pretty simple paperwork. There's your legal description. Very important that you have legal description. You have the address and you got the parcel ID there. Those are some of the other elements that we check with all of these. And that's good. So we know where this originated from. If Fannie Mae ended up with it, it was because it went into foreclosure. Foreclosure clears the title. So I don't have title concerns going past this date and time. And now I know that that's been conveyed over here with a special warranty, a special guarantee deed over to Harbor. So then I'm looking at, how did this company that we're buying it from, which is called Equity First, where did they get it? Well, again, in the paperwork here, I can see that we've got another deed here. This one's a quitclaim deed that was filed back in 2018. So Harbor had it for 7 years, right? So Harbor had it in 2011. They created a note when they sold it to the borrowers. They collected payments on those notes, and then they sold this over to Equity First, okay? So we can see that was done on a quitclaim deed. Now, if this was done on a deed, that means that the property ownership, once again, has gone from Harbor to this other company called Equity First. Okay, so I'm gonna do a little twist on this in just a second, but that's what's happened at this point in time. It does say subject to all liens and encumbrances, right? All claims on this property. And again, we quick check with the legal description and the parcel ID, and we're good to go. And that's that document. This was just a copy, by the way, a duplicate. And then I can also see this. This one has an assignment of seller's interest in an agreement for deed / land contract. And I can also see that that was done at the same time as the quitclaim deed from Harbor over to Equity First. Okay, so that's what do we have here? We have a security agreement called an agreement for deed. Okay, and an agreement for deed, also known as a land contract, is a type of arrangement that you won't typically find in bank financing. When you get a loan from a bank, you promise to pay it back, and then you sign a mortgage. Now, that mortgage might be a traditional mortgage or a mortgage called a deed of trust. In this case, when Harbor sold this, it was a conditional arrangement that said, okay, Harbor owns the property. We saw that in the first document. Harbor fixed it, and then they sold it to these borrowers. And Harbor said, we'll sell it to you with financing, but we're going to hang on to the deed until you pay us in full. Pretty good arrangement. That's what way, if the borrowers don't pay, then you don't have to go through foreclosure. All you have to do is enforce this agreement, which says that I can convert them to a 30-day tenant and evict them. Much quicker process. And that's why you see these type of instruments in the seller finance world, not the banking world. So that is our security agreement. And our security agreement also is backed by a note. Okay, so there was a promissory note. I promise to pay you back. If I don't, and you're still on the ownership of the property here, but this note was allonged, which is a fancy way of saying assigned. It's been passed through to Equity First. Okay, so right away I can track this and say, all right, so it went through Fannie Mae got it to Harbor, Harbor owns it. Harbor at some point in time created a contract for deed, and they collected payments on it, and then they sold the contract for deed along with the note over to Equity First. Okay, that really doesn't take that much of a thought process to get there, but I realize it's new to people. Well, how this is how notes are traded all the time, including banks. When banks create notes, they sell them to Fannie Mae and Freddie Mac. Most of you don't see that or know that because you're still making payments to the bank. Now, every once in a while, you get a notice from the bank saying you no longer make it to bank A, you make it to bank B. And I'm sure many of you have received that. Did that affect your payment? Did that do anything? No, it was just sold to another entity there. And most of the time, banks are, by the way, selling servicing rights, but that's another story. So those are the documents that led up to Mr. Kelly having the opportunity to buy this note. I was facilitating this transaction. I didn't own this note, Equity First did. So he's buying this note directly from Equity First. Now, if you were buying this note yourself, you should probably have other questions, which I'll get into, but are there questions so far?
Not related to that so far,
Okay.
Just a couple other ones we can hit, but let's stay on here now and we can hop back over to that.
Okay, cool. So
here's one real fast. So we pick up contracts second gen through smaller banks, ? Thus avoiding Fannie Mae, Freddie Mac.
Correct. So there's actually 3 different main funnels of inventory for notes, but that is indeed one of them. Companies like Harbor, what a company like Harbor does is they buy real property, and then they sell it with seller financing, so which is converting it to paper. Then at some point in time, when they start to cash out that fund, they have to sell those notes.
Okay.
And that's one of the opportunities that opens up with that. So we can track where this started from and how it got to Equity First in this example. But what about the borrower? Certainly, you would have questions about the borrower. All you know so far is that they've been in there for 10 years, apparently making payments. Wouldn't you like to see that? Sure. Right. So there are things such as payment histories. Payment histories are not going to be recorded. the documents I showed you so far, they were all recorded with the exception of the allonge. They were all recorded on public record. So any one of you can go on the public record sites and look those up. You're not going to find certain things such as notes. Notes are considered personal property. Therefore, you're not going to see the assignment of notes, which is the allonges, and you're not going to see the payment history either. But that's something that's requested. So when Mr. Kelly contacted me about this note, saw it advertised, I'm really interested in this one. Great, let's schedule a call. We got on the call, we shared a screen just like this, and I showed him, I sent him all the documents and walked him through the whole procedure here. So the next thing we had to do was request the documentation from the note seller. We need to see the payment history. We'd like to see the origination documents, those sorts of things. So I've got those as well. And let's see. So this one starts with the whole loan. So when Harbor did this loan, they did go through a procedure to see if the borrower was going to have the ability to pay. It's one of the thresholds that we need to qualify for Dodd-Frank, even though this was pre-Dodd-Frank. They do go through a qualification process for this borrower to make sure that they're going to have this ability to pay, or the likelihood that they'll pay. So the person did have to authorize, forms that would be released so they could look at the person's taxes and all that. So that's good for us. We have somebody who's in that house that has gone through a qualification process. Here's the agreement for deed. So that land contract that was assigned over in the other documentation, this was the original. So this is really what you're buying, this agreement right here. Within this agreement, the security agreement, this tells us what our rights and obligations are, and it also tells the borrower what their rights and obligations are. Okay, so here's the loan amount. $43,250, $650 per month. Here's when the loans start. The loan was originated at 10% interest. So again, we're crunching our numbers, making sure the numbers match up, in your financial calculators and such. They're responsible to insure the property. They're responsible to pay the taxes on the property. If they do sell the property, they can do that. We're keeping any kind of mineral rights that are in there. We're selling it to them in as-is condition. Et cetera, et cetera. So this outlines all of the rights and obligations for both the lender and the borrower. What if they don't make the payments? There's repercussions for that. How do we know what they are? They're right in the agreement. That's the agreement that we are buying. So when you buy these, again, instead of walking around a house and seeing how much it's going to cost to fix you up, for example, we're looking at the documents going, okay, what if they don't pay? What can I do? What are my rights? Okay, so you start to learn in these contracts where to go to look for certain key information. And this one tells me that if they don't pay, then the loan accelerates. I can convert them to a month-to-month tenancy. And if they don't pay on the month-to-month, or I choose not, I can just evict them from the property at that point of time. That's why I don't have to go through a foreclosure in this process. So it is important for us to understand the terms of this document that we are buying. So the first couple of times you go through this, you're probably going to do a little bit slower versus somebody who's been there like myself long enough where I go, yep, got it, this, that, and the other, and already know where to look. So that's good. We understand what all those are. Everything's signed. Here's the note. So we have the security agreement, which is the land contract. We also have the note. We buy notes that are secured, just like I said in the beginning. There's the note about, there's the promise to pay it back, all of the terms. If you pay late, here's the late payment fee. Here's where you send the payments. Everything is in there. Okay? That's what they look like. So when you say, what does a note look like? Well, that's a version of a note right there. And that's why these documents are so simple. If you have a template of a note, well, what do you have to do? You have to change the date, the amount that was borrowed, the interest rate, the payment amounts. I mean, all these things, everything else is just a template. So you really don't even need an attorney to create these notes. Okay. And there's our legal description and our ID. Okay. They also understand, this is a good one. This is certifying that this borrower understands that this is an agreement for deed. And that if they want legal advice on that, they can get legal advice on that before they sign the agreements here. And that's important too, because imagine a scenario where somebody gets into an agreement like this, where they're not on the deed yet. They're not going to get the deed to the property until they pay it in full. So what if they go 2 years down the road and they don't make the payments and they're evicted? You know, they're going, wow, but we built up a little bit of equity. We had this. It's like, that's not what you agreed to. Okay. And by having this as a separate agreement where it's acknowledging, you know, that this is not a traditional mortgage, this is an agreement for deed. If you need legal advice, get it. That would help if there's any kind of a legal proceeding down the road. And then it's all the other standard stuff, lead-based paint, riders they had on there. You know, these are things that we just look at and go, okay, got it, mold, got it. Here's the Truth in Lending Act. Great. So they showed them this is a part of lending. So that's all in there. I don't have to read the whole thing. I just have to see it's there. Here's the actual settlement statement when the person bought it. So they did put down a very small amount of money. I mean, less than $1,000 overall to purchase this property, but they've been there 10 years. You know, so at that point in time, it doesn't really matter. So there's all of the info about that, everything that they've checked. Here's how much you're paying in interest. All the paperwork is in order on that. It's also being escrowed. So as a part of the documentation they send, is this being escrowed? And escrowed means, is there being payments for principal and interest? And here there is, right? So you have your monthly payment, principal, interest, and then you have taxes and insurance. Okay, and that's the total amount due. And we have third-party servicing companies, by the way, that collect the payments, hold the escrow, pay the taxes, pay the insurance out of that, and just send you your money. So the gentleman, Mr. Kelly, who bought this note, he's already receiving the payment. So the payments are going to a third-party servicer that will account for all of the payments. They'll hold the escrow, they'll pay the taxes and the insurance out of there. If the borrowers are late on a payment, they'll also collect the late payment, and they just send Mr. Kelly now his payments every single month, which they'll put in the form of a payment history, which is what you had here. So payment history was provided to us by the note seller to show that this person is making payments. And if you recall in the paperwork, well, maybe you don't recall, but I'll tell you, in the paperwork, Equity First bought this in 2018. So we have paperwork going all the way back from when they bought this, showing all of the payments that had been made on the property. And we just go through that and assure that all the way up through 2021. And go through that. How does it look? And that's essentially the paperwork on the background of these deals. So then it became a matter of, well, is the property really worth $64,000? And is there anything else in the title that I may not be aware of? So before Mr. Kelly in the Money Club bought this note or closed on it, we got it into an agreement. So he locked in the deal. So it's his right to buy it, subject to an acceptable BPO and title report. So he went to a friend of mine in the industry, and he made one phone call. I need a BPO and I need a title report on this property in Indiana. Within 3 days, he had that. Property title was clear, no other liens on there, and the BPO came in at an acceptable number. Now the transaction goes through a closing process, which, by the way, is much easier than a regular real estate closing, because believe it or not, when you buy a note, there's nothing for you to sign. You don't sign a single document. Only the seller signs. And what does the seller sign in this case? The 3 documents. They sign the deed over to Mr. Kelly's company. They signed the assignment of beneficial interest in the land contract over, and they allonged or signed the note over to him. That was it. 3 documents that are signed. They send that. He wires the money. Transaction closed. Record your security agreement, and you start collecting payments next month. Now, I know that was a very condensed version of a note deal, but that's really what it looks like. And when I work with people, obviously I can slow that down and make sure, you know, we've looked at everything, but hopefully that gives you a good feel of what something like that looks like.
Yeah. And I think Mr. Kelly's one where it says anonymous, but it says, Kevin, make sure to let them know that I also signed up to be a client of yours based on your knowledge, guidance, and passion that you displayed during the initial process. So
yeah, absolutely. He did, and saw the value of that. And because I work with people to get them through this. And once you start to go through, you'll start to see all kinds of new things that open up. And every deal, you know, there's more complex deals than this. There are notes that are non-performing and such. But yes, like I said, I speak with Mr. Kelly every week now, looking at new deals. We're talking about different topics. He's going through all of my educational courses. Absolutely. But the inventory, because of this, let me just do this real quick for you, Steve, because I think you'll get a kick out of this too. Back in March, when I did a presentation for your group, I was showing them the latest numbers on the forbearance plans. And all these plans were supposed to expire. So you had about 27% of all the loans, which was 7.2 million loans, were supposed to expire in March alone. And then you had about 6% here in February. Well, of course, what did the government do? They pushed it all back. This is what it looks like now. So this was back in March. This is now August. And in August right here, they pushed everything back. So what does that mean to everybody? That means that you're going to see, you can ballpark the numbers there. We'll call that 700,000. We'll call that 4. There's going to be about 1.6 million people coming out of these forbearance plans by the end of September. Not all of those folks are going to have the ability to pay. I guarantee you there are people in these forbearance plans that think they just never have to pay that money back. That is completely false. If they've been not making payments for upwards of 18 months, they have to pay all that money back. Now, it depends upon what kind of forbearance agreement they went into, but there's going to be some people in trouble who are not going to have the ability to pay back. Maybe they're not working yet again. And that means that the banks are going to start doing foreclosures. However, having said that, most banks today don't do that many foreclosures anymore. Instead, they package up their non-performing notes and sell them. So we're going to see a rise of inventory in non-performing or semi-performing notes. There's no questions. It's right in the numbers. It's not going to happen in foreclosure. I know there's a ton of information on the screen, but nationwide, look at down here on the bottom. Nationwide, in June, we had 4,400 foreclosures in the United States in total, 4,000. We had 3,000 a month before, 3,000 a month before. So since January, there's been less than 6,000 foreclosures per month in the US. You compare that back to 2008 and 9, quite a difference in foreclosures. And one of the big things is there's a component within Dodd-Frank that makes it better, quicker, easier, and much more cost effective for banks to sell non-performing notes versus foreclosing. And that's why you'll see this wave of inventory here that's been growing, but kind of been pushed back. This wave was pushed back when they extended this moratorium on these forbearance plans. But I can't see them pushing it back. Well, I can, but it's hard to imagine they would push this back again. At some point, it's going to lead up. So we will see more inventory.
So what's the advantage of buying a non-performing note if somebody's not paying on it? Because then you're able to go in and foreclose yourself to get the property, or why would they pass that on, I guess?
Non-performing notes are less expensive, number one, right? So we have a lot of people understand real estate, right? So if you're looking at a house, you could go buy a house and pay full retail. That doesn't take any effort, right? I mean, you can go pay asking price for a house with a little discount, maybe. That's pretty easy. What real estate investors do to make their money is they find that hidden gem that needs work that they can buy here, renovate here, and then it's worth this, right? So they look at all of that. Anytime you're buying broken houses, you're getting them at a discount. That's where you make your money. So you can liken these to buying a broken note. These notes are not working. Well, how broken is it? Just like the house. Is it vacant? I mean, did the people just, say, we're out of here and leave? And if that's the case, I might skip trace, see if I can get a quick claim deed from them, or I have to foreclose. Or are they still living in the house? And if they're living in the house, is there any evidence that shows they want to stay? Are there kids' toys in the yard? Are they taking care of the house even though they're not able to make or choosing not to make the mortgage payment? Are they paying their property taxes but not their mortgage payment? So there's little signs that are indicators of these folks want to stay. And then you look at the rent. You go, oh my gosh, a rent for a 3-bedroom house in this part of Ohio is $1,800 a month. Their mortgage payment's only $600. How can we get them repaying again? So we take a non-performing note and make it reperforming again. And that adds value to it, just like taking a house, fixing it. We take broken notes, excuse me, and fix them up. And then we either keep that or we turn around and sell them. So if you can buy a non-performing note on a $100,000 house and maybe they owe 80 grand, and a non-performing note, you might be paying 40,000 for that note. You got options, right? I can work with the people. I can help them stay in their home. I might grant them a temporary loan modification. What can you afford right now? Your payment's usually $650. We can afford $500. Okay. Start making $500 payments, right, for 6 months. And then we'll look at moving it to a full loan modification, that sort of thing. So we can work with people. It's what we did the last time the market crashed. That's what we did because the banks weren't able to do it. They don't have the staff nor the willpower to do it. The Wall Street firms really don't care. They're not going to have the patience. We can really work with people one-on-one, and that's where the opportunities will come on the non-performing. But again, Stephen, it does come back to what's the collateral worth, right? Especially if it's vacant. And then if you want to streamline it, tweak it, you can look at states like Georgia, where it takes 90 days and less than $1,000 to foreclose. Missouri, 60 days to foreclose, versus here in Florida where I am, it take you, well, you're in New York. So New York's even longer, about 18 months to foreclose. Florida, we're looking at 12. So you can target your investment based upon that for not performing.
Right. Yeah. I mean, it's good to know. I mean, it's part of, like we always talk about in real estate, you got to be educated. Every area is different. Every region, state, everything's always different. So you got to know what you're doing. So that brings up a good question. Can you invest in notes in all 50 states?
You can. Is there going to be available inventory in all 50 states? Probably not. And who are you competing with? So another layer of this would be, for example, if you're investing, maybe you're in California, you say, I want to focus on California. You can certainly do that. But the problem is you're competing with equity firms at that point that probably are more capitalized than you, and they're willing to pay a premium for that. What those companies don't want, because their business model is a little different from a small investor, they typically don't want the lower price band stuff, because they look at their hard costs and go, a BPO and title report costs the same on $1 million house as it does on a $50,000 house. Servicing fees, cost this much. They look at their overall hard cost and go, let's trim the fat here. Let's get rid of the lower end stuff and let's focus on the higher end stuff. If you want to focus on higher end stuff, you can, but I'm telling you, you're going to have big competition that knows a lot more than you, probably better funded than you, and also willing to pay more to discourage you. And that's a reality. If you focus on the lower price band, which is a little different in every state, you don't have that competition because the big boys don't want to play in that field. That's why we focus on those areas. And those areas are going to drive you typically to the Midwest and the Southeast. And then there'll be opportunities in other places. But yes, you can in all 50 states, but do you want to? Probably not.
Okay, awesome. Are there any shorter term notes, or are they all fairly lengthy?
Yeah, the one I just showed, this one went really, really like, in fact, Mr. Kelly emailed me right away on this one. I said, yeah, that one's already gone. I said, I kind of knew that one would be gone. This is one I just put up on Slack the other day, and it was gone before it really even hit there. $100,000 house, $45,000 note on it. This only had 14 payments left with a $20,000 balloon. So this one sold actually for just under, I know what it sell for. I think just under $20,000. And for 20 grand, they got 14 payments of $424 a month. And then the balloon is going to be in the 14 months for $20,915. So if it all pays out and they come up with the money for the balloon, great. You were in this thing for 14 months. Some people are thinking, what if they don't pay the balloon? I'd be fine with that too, because you're making whatever the yield is on this one, double-digit yield. And I'd push it back another 14 months, or I'd push it back another 12 months or another 24 months. So no problem on that one. So this was a real short loan. And by the way, the people put, gosh, what did they put down on this one? $15,000 on a $45,000 purchase, which is really, really strong. So they'll come up with the down payment. So they can be all different lengths. But I'll tell you what, some people like them with more legs in them. For example, on this one that Mr. Kelly has, he's got 250 payments remaining. he could take this note if he wants to down the line, and he could just sell a part of this note to somebody else. Okay, so 250 payments, 373.85, and you'll learn the math in this business too. It's let's see, I can't remember what he paid for that, so I won't do that. Here's what he can do though, in general terms. He can, oh, you can't see my screen anymore anyway, can you? I was going to go back to the screen, but I don't need to. He has 250, think of it as 250 units, monthly installments of what did I say, was 373 per month. If he chose to, he could sell 10 years worth of payments. Okay, 60 months of payments, 70 months of payment, 100 months of payments. He could, with a note like this, because of the length of the term, he could sell a part of this note for more money than he paid for the whole note. Absolutely could do that. In fact, I'll do it in the background, maybe here. If he sold, what do you buy this? He could sell, heck, I don't know, at an 8% yield. He could sell 100 payments for $27,000 bucks. He could sell 150 payments. So it just depends what he wanted to do, or just keep it. Some people do like, and I get the question was probably more like, I don't want my money wrapped up for 250 years or 250 months, sorry. And it probably wouldn't. How many people do you know that actually pay their home off, in 30 years? Most people pay it off early by selling or refinancing or something like that. But we have the option, without having to deal with a borrower, we can sell any number of payments we want at any time. But if you're used to 5-year CDs or 5-year investments, you have two choices. You could buy a partial note, because some people sell those, or you could just look and find notes that have a shorter term. Yeah.
Yeah, you got a lot of options there.
Oh yeah.
Very cool. All right, let's see. How do you, this is just a general question, I guess, so this would be perfect. How do you find notes for sale, and how do you verify the validity?
Good question. Part of what I just did very quickly for you is checking that validity, because are there people who might represent that they own a note and are looking to sell it that don't really own the note? Well, let me ask a question. Does that happen in real estate? Right? We've all read the stories. One of the things that you look at is, I want to see the paperwork. So clearly, if I was buying that note from Equity First Funding with that documentation, even though I know we went through that rapidly, with that documentation, I can see here's where it started, then went here. They've got it. It's recorded. So the due diligence is where you check all of that information. Where do you find these? Depends. There's online trading platforms like PaperStack today that has assets that are on there. Do you still have to do your due diligence? Of course. We have people who do their own direct mail campaigns. They buy lead lists and they send them to them. We have people who go to the bigger companies like the harbors and buy notes directly from them. We've got servicing companies that, gosh, we just got a tape. A tape is a Excel spreadsheet of, I think, 130 non-performing notes from one servicing company yesterday. So inventory is not a challenge today. And again, it's likely to grow, which means prices will, if anything, have downward pressure. Yeah.
Okay. And then, so you and Kevin, you're doing coaching and supplying lists like that too through what you do? Or
yeah, I have preferred, and I've been in the business for 30 years, so I have preferred vendors and people I want to work with. Equity First Funding, for example, the company that was on this last note, I've known them now for over 12 years. How do I know them? They came to my 3-day training class probably 15 times over 2 years. I got to know them pretty well. They would always come back. And I always featured notes at a 3-day training that are live deals. So sometimes they would just buy the notes that I feature in a class, and they wrote a chapter in my book, Real Estate Without Renters. And so I've known them very well. So they have inventory, which I wouldn't say was private because they did have a website, but unless you knew who to look for, you wouldn't know it. So part of it's personal contacts, other of it's public. And again, it's really, if you have the knowledge and the training on the due diligence, it doesn't matter really where the inventory comes from. That's why I said there's really 3 funnels three funnels of inventory that we look at. But I think the big difference with me is I work with people one-on-one. You know, that's what I do. So when we go through a deal, it's you and I looking at the deal together, going through everything. Yeah.
All right. So Jameson says, if you have to foreclose on the notes, what's the average time it takes for the whole process? A year, like a typical foreclosure? What's the estimated cost to do this?
Yeah. So on the cost, the best guide I have found is Fannie Mae puts out a list every once in a while. I've got the latest one that shows what is the maximum amount that they will pay for attorneys in every single state. And a lot of attorneys use those as a guideline for what their pricing is. So you're looking at a range of anywhere from $1,000 to about $4,000. So you could say around 2,500 average in the US. And then time-wise, it depends upon state law. There's states that are under the deed theory. There's states under the lien theory, meaning judicial and non-judicial foreclosures. But there's regular, I mean, you could do a quick Google search and find plenty of sources that outline the timeframes for you. I like foreclosurelaw.org, because it does a good version in plain English, non-legalese, about how the process works and about what the time frame is.
Yeah. All right, let's see. So who is so when they're asking who's servicing the loan, how much do you pay for the service fee? And that's part of like the partners you say you work with, right?
Yeah, there's third-party companies. There's a handful, probably 5 most common companies that people use to service their notes. And the price ranges are pretty close. Some work on an a la carte menu, some work more on a group package price. But you're looking at, for the note I went over with you earlier, that one being that it's a performing note and it's being held in escrow, I think you're looking at $18 a month. If it was without escrow, probably $15 a month. If a note goes bad, or if it's a non-performing note, and you know there's more involvement that the third-party servicing has to do through workouts, then there'll be an a la carte price, going up from there. But very, very reasonable for what you get, because they do all the accounting and hold all the escrow. Please don't create notes and hold your own escrow, folks. You're just begging for problems. That's one of the worst things you can do.
All right.
Third party.
Looks like we're wrapping up here. Somebody just said, what's the difference in notes versus like tax liens? Is there anything similar?
Yeah, notes and tax liens. I put together a series. I got to dig those up. I put together a series: notes versus stocks, notes versus bonds, notes versus rental, notes versus tax liens. Tax liens today, because they're all online, well, just for everybody to know, the tax lien, what you're buying is you're paying somebody's property taxes for them. They have to either pay you back or the property's forced into a foreclosure sale. And you can see stories of people making really good money on that. That's like hitting the lottery ticket, everybody. It's very difficult, very competitive space. In Florida here, where that's a very popular, when they went online a number of years ago, people bid down the earnings down to 1-2%. I mean, it's crazy. So you really got to find the needle in the haystack. You're better off on those, maybe checking over-the-counter tax liens, but your notes are much better than tax liens.
Right.
I used to teach tax liens too.
Yeah, I'd agree with that. Tax liens get very complicated very quickly too. All right, and somebody just said, what do you mean by holding your own escrow? Can you just define that?
Holding your own escrow. In other words, if you do that model that Steve was saying, you bought a house and now you're selling it to a consumer with seller financing, and they're paying you principal, interest, taxes, and insurance every month, PITI. When you collect that money, the taxes and insurance portion is not your money. And you need to have a whole separate escrow account for that. And if you ever touch into that money, or gosh, if you took that money out and spent it and you didn't pay their taxes and insurance, you're setting yourself up for liability right there. So if you're seller financing a note and it's just principal and interest only, you can do that if you want to. After 4, they're going to consider you a business, but you can do it. But if you're holding escrow, it puts you to a whole different level. Anybody who's a real estate agent on, which I'm sure there's a few, ask them, they're probably nod their heads going, yeah, with our realtor, he doesn't even want to hold checks. In Florida, a lot of real estate companies will not hold escrow checks. They make you take it to a title company. They don't want to deal with it. It's a big audit category.
Absolutely. Yeah, for sure. All right, perfect. Well, that was awesome, Kevin. Thank you so much, man. It looks like we got all the questions. You answered everything. You shared a lot of information. What did you guys think about this? But any final words there, Kevin?
No, it's just there's plenty of opportunity, and I'm here to help. I'm really my business model is very very limiting. I work with people one-on-one, and that's really what I like to do. And people are getting great results. So I'll plan on, Stephen, putting for sure, once I get some more case studies for you and such, we'll show what your people are doing, people that have come through the Money Club and your other entities there. But no, the note business is great. It's more than a niche now. It's going to be an ongoing thing, and opportunities with inventory are definitely changing by the end of this year.
Yeah, absolutely. Looks like everybody loved it too. So thank you so much, Kevin, for being here. Highly recommend. I put the links, schedule a call with Kevin or shoot him an email, and you guys connect and, make it happen, get that money moving, get that money working, and let's grow some wealth. So,
all right, if you like that video, make sure you check out this video right now. And also don't forget, subscribe to my channel, and don't ever forget to smash that alert button. We'll see you on the next one.